All right, guys, thanks for your patience. We had our soccer match today and got back a little later than I thought, so I was pushing it on time. A 1-1 draw. It was difficult, but a satisfying game. All right, so this is the podcast for August 26, 2018. I'm going to lump together both the day trading and the swing trading Q&A. They're closely related, and I'll be putting the link into both courses. So the ideas, I think, carry over pretty well. So the first one from Ken was when framing trades and when there are multiple previous humps in the dragon, which of those targets makes sense when looking for 2-to-1? Would it be the most recent previous hump or another one? My basic answer on that would be, when I'm looking at the chart, if I can see a reasonable resistance around 2-to-1 in the basic time frame that I'm going to hold the trade, then I'm content that price can get back to that level reasonably. And it's only when we're near the all-time highs, like we've been, say, in the S&P lately, that I get concerned that the price is going to be rejected at that level. So if it wasn't a 2-to-1 to previous highs, I might not take that as a basic swing trade. But if we're in a channel that has a bunch of humps, as long as I can see that it can get to our out of that, then that I'm not as concerned. I basically want to ensure that I can see 2R is not a real stretch of the imagination, that I'm not trying to believe in the trade too much. So as an example, then, if we were framing this trade here and we wanted to get long right here, and in the past maybe it looked like let's see, a hump, and then dragon and come down. So let's say we were looking and it came down into here. So I was framing this trade and deciding if I could get long here. This is where I might take let's see, I might take this hump of the dragon. I might come back to this one, this one, this one. This one lines up pretty closely with that one. So I would really look at all of these as reasonable price targets up in here. It could get to all of those price levels and begin to fail. And so if my position sizing box was like this, and then I went 1, 2, I wouldn't have any trouble saying, yeah, it can get back to this price level without a big stretch of the imagination. Now, I might also say, hey, look at this one right here. If price came up here and then failed, that would not be very surprising, and that would be one where I would go ahead and cash that win. But it could also very easily just do this, and maybe it goes right to here without triggering my exit. Let's say. So a 2-to-1 to that level. I look at that price level and I would say, yeah, it can get there, and then if something is going to give me better than my average win, which is usually like 0.6, but it were to stall at 1R, I would go ahead and invoke the 2R battle drill and just preserve that profit. My main idea is that I don't want to let, if my average win is 0.6, whoops, stand by. Jeff, are you not seeing the screen? You should be able to see it now. Yeah, so if my average win is 0.6, yeah, I'm really trying to frame trades that I can see a 2-to-1 is a reasonable target. It may not be the first target, but it's a reasonable target. So if I was up around 1.0 on the entry, from the entry, and it failed here, this is the region that I want to cash it in. If I got to 1.0 and my average win was 0.6, I'm not going to let this thing fall back below 0. It'll be on the it'll be recorded there, Jeff. So it should be you should be able to see it. Is anybody else not able to see the screen before I go any further? Anybody having a difficulty there? Okay, it may just be Jeff's. Okay. Ken Hum wasn't here earlier, but anyway, yeah, that should answer his question. Okay. All right. So the next thing I'm going to leap ahead a little bit here to cover Peter's. I'm going to come back to question 2. I want to finish up with that one. So this one for intraday. Once a few owls are initiated, is it best to focus on chain trading only those few symbols through the day, or is it better to also look for other opportunities in the watch list? I would put it this way. I think it varies based on your span of control. So if you find that you can manage a couple owls with the chain trading comfortably, and you're still able to look around for other opportunities, what I would say is look for some more owls that are occurring later in the day. Or if you had a couple owls and then they were all kind of moving in towards that Z3 pinch, which is where you would normally be thinking about exiting as it gets into a stable sideways pattern, it might be at that time of the day that you close out the owls and then you start concentrating on the Z3 pinch and then the breakout. But I think it comes down to two ideas. The first one is the span of control. If you can manage those other scans without jeopardizing how well you are managing the trades that you're in, then I would say, sure, go ahead and add some additional ones. The two I would start off like mastering, like a partnership, would be the owl and then the Z3 pinch. And the reason is that the owl pattern itself includes, that occurs after a significant unambiguous move, right? And so something had to happen, and then enough of a retracement occurred for the owl to start coming online right around in here. And the owl's going to work, or the owl is going to fail. You know, and that's where you have the collapsing dragon right here. If price gets below the belly of the dragon or the belly of the RL10, then we can say that the owl pattern failed. This would be that pocket. So that's really the chain trade that comes with the owl or the P1F. Well, if you had a couple owls fire and instead of failing they actually worked, and then they start to taper off, then you start getting this kind of sideways chop. You'll notice that the Z3 lines, the Bollinger Band lines, come back together, and now what you have forming is an SQC. And if it gets really tight, then you get a Z3 pinch. And then your trade is either a violation of that, a breakout this way or a breakout that way. You get one of those two trades. So in my view, if you have mastered this entry after the unambiguous move, and then you have mastered this little complex here, this chain of the owl and the P1 failure, that's good for all categories of trades where it's already volatile, where you've seen a big move already. And then when that run is done, it moves into this absence of volatility. Price gets to a new stable level, and then there it stays. And now this run is done. And now it's much more about this sideways quiet channel. So I think if you start with those two endpoints, one, a trade that sees a lot of volatility at first, the trade is in play, and then you master this entry down in here, the owl complex, that chain. And then you master this one when there's the absence of volatility. Now I think you can look for that pattern later in the day. But if in your watch list, if you're seeing a bunch of owls occur at different times of the day and you've mastered that pattern, go ahead and master that pattern until you've taken up all of your span of control. So if your span of control were 4 and you had 4 owl trades that were open, then you've already sort of optimized your mission command, your span of control, your ability to manage professionally. But if you've got a span of control of 4 and only 2 owls are on, so you have a little more attention and some capital, and then you see, hey, the owls are chugging along nicely, but they haven't really gotten the sideways stuff yet, or they haven't failed. And so you get 2 patterns that are chugging along. And meanwhile, on another watch list, you have, from your watch list, you have 2 things that are in these Z3Ps, and they're getting ready to break out. Yeah, if you can take those without violating your span of control, go ahead and go for it. But that's the way that I would look. I would look for the owl complex and then that Z3P complex. Those are the 2 that are like at opposite ends of the spectrum of the day, in terms of volatility, and both of those can be traded with a pretty simple set of rules. So that would be my answer. Peter, did it give you what you need? Question number 2. I've noticed that the second owl entry after a failed owl tends to have a decent chance of working. Is that observation valid? I would say yes, and I think if I remember this chart, I think you sent it to me a couple weeks ago. But it looked like this, the price came down and you got enough for an owl, and then it didn't really pan out. But then you get like a second owl entry somewhere around in here. In other words, it didn't turn into a second leg down. Normally when we see the owl fail, what we're expecting is the size of this move of the original one to be a second leg down. But if it doesn't do that, if instead you end up getting a second owl entry here, quite often that's going to be the one that works, and I don't mind taking that one at all. And where it officially really works is when the previous hump of the dragon or the RL10 gets violated here. So a lot of times you'll have a chance to take the second owl entry right inside here, and then after this price level gets violated, that's like an emerging dragon, and then off it goes. So what you would have actually done in here, this almost looks like a pocket. It found support here, it broke through that resistance, and you were able to get a second owl right in here, and then off it goes. So the main idea on this one is it became a double bottom, and off it went. So yeah, I would just keep staying with it. And the big thing is that failure to fail further. So yeah, I would just want to, re-entry is part of the system. In this video, I said not to short a big runaway move to the upside. Yeah, and the specific reference on that one, excuse me, I don't remember that was Intel, but the main context of that was this. So on a swing trade, that thing had the thing we were looking at had been like in a sideways quiet channel, and then there was an earnings release, and so there was a gap up, and this thing started going north after an earnings announcement. And so if I wasn't paying attention to any of this information and realizing that that was a big gap, that first initial move would have been that's an unambiguous move. So therefore, once this thing starts failing, all the conditions for an owl are in place, and so I should expect this thing to, to do that. In that particular case, what I was saying is that when you have that kind of an anomaly, you have something that had been at a Z3 pinch and then broke out to the upside, and it was charging north. In that special case, I'm much more likely to look for a resumption of it this way, and not trying to fade it with an owl. Yes, it's absolutely true that the owl does require an unambiguous move, and yes, a big gap up and then a runaway move to the upside. Yes, that's an unambiguous move. Just recognize that the owl is always going to be a counter trend trade, and so when you have all these swing trade guys that are buying it, the chances that thing immediately fails and comes back to cover this great big gap is pretty remote. Not saying it can't happen, but I would just say if there's 50 things on your watch list, why trade the hardest thing to trade of all? I would much rather see an orderly move. Let's say something was trading like this, an orderly move, and then it moved up and was starting to fail. I would much rather take that one as an owl pattern than something that was pure sideways, big gap up, runaway freight train, and then just say, well, that's an unambiguous move and it's going to come back. I think there was a lot of things baked into the cake that said that one was a tough one to put an owl on. But remember, the possibility that it comes back to the open is there, and if it violates and makes a new low of the day, then the next place is back to the previous close. So there is an argument to be made that the breakout was a false one. It's just that when that's done in combination with a swing trade, you have a bunch of institutional money that is now believing in the earnings report and that thing is going to go. So that's the caution that I would put on that one. All other things being equal, I would say why make it hard if you have other patterns intraday that don't have that kind of setup. Then let cooler heads prevail. Okay. Let me come back now to question up in here. All right, so I just sent this one out on email. So this is from a gentleman from India, I believe, that I've been working with. And just a little background on him. He has taken the swing trading course only. That's the only course he's taken with me. Hasn't been to an in-person workshop, and has been working through the details for a couple months, and has put together a personal trading plan that fits him. And he's working on swing trading one day at a time using the Max Payne range compression candidates. Right? So just as a quick review, so MPRC. And the main idea is that from the 10-day high, we take the distance from today's price, or yesterday's close, if you will, and we express that as a percentage, a percentage lost. So the price lost from the high divided by price gives you a percentage of pain that thing is in. And then on the last day, we measure the range from the high to the low, so we take the range. So we take the pain, the percent loss, and we divide it by the range. And so there's two. We want to get the biggest ratio. We take the absolute value of this thing, right? So in order to get the best ratio for Max Payne range compression, you want the biggest loss divided by the smallest divided by the smallest range. That gives you the biggest ratio. And the reason is that there's a certain amount of negative energy and emotion associated with the pain of all that losing. But then if you had a really tight little doji, then that one is the lack of fear, and it hasn't come into greed yet. That is the hugest psychological shift that you could expect to see, from runaway fear into a very tightly controlled, equal battle between bulls and bears. So it's not unusual to see that as a red Niagara and then a doji. And then we set that up as a trade that can go in either direction. And so it might be 5-1 on the upside. And because, to the 10-day high. And if it lost 5 of these little ranges to go from here down to here, we think the next one could be also that big. So there's a 5-1 implied in either direction when you compare it to the size of the range. So again, what you want is a very small range for yesterday's price, and then you want the largest percentage loss from the 10-day high. Then we just treat the 10-day high as a price target that it could get back to something like fair value. And so what this sets up is like nice one-day pops, and you can certainly trade it. If that was yesterday's high and low of the day, then that becomes the yellow zone, and what you're looking for is a nice orderly open inside yesterday's range. And then if it fails below yesterday's low, you're short, or if it goes above yesterday's high, you're long. So that gives you a very clear set of unambiguous signals, and then you just use this space between yesterday's high and low as the execution R, and you use something like 2 ATR as your position sizing risk. So you have the execution risk and a position sizing risk, and that's pretty clean and straightforward. So that's the basic form of the setup that this gentleman is using. And he's only holding these things intraday, and he's looking to try to get out at some moment of advantage. And he's carrying no risk overnight, and he's looking at large cap stocks. So this was his numbers for July, or maybe this combination of July and August, if I remember. But it was about 1 month of trading. So he's up about 4% after commissions. His average win was 0.75 R. His average loss was minus 0.4 R. His win rate is about a coin flip at 0.48. His average win is 1.75. His average loss is 1. So that's about a 7-4 payoff, which is almost 2-1. His SQN is 1.15. So he asked what I thought about that. So here's what I think about that. Just a second. Peter had a question. Peter, I'll get back to that one after I get this one. First of all, that this is a system that has it's a coin flip that pays almost 2-1. I would say, I would ask you, how many times a day do you want to play that kind of a game? And your answer should be as much as humanly possible. Some of his observations were from his trading journal. He was not able to follow the 2R battle drill properly, and I said, well, that makes that a very high payoff practice. He's having trouble taking profits once the trade gets beyond 1R. So it gets past his average win of 0.75. It gets past 1R. It's approaching 2, and he's having a hard time cashing that profit until it comes all the way back. So he's given up a bunch of profit on the far side of the hill. So that's what the 2R battle drill should help you with. He notices that very few trades are able to pull through the 2R boundary. That's entirely expected, and that's why the 2R battle drill is a high payoff for him, because that's going to help him capture more of the wins on the far side of the hill. He's using a wide stop loss, but he notices that this keeps him psychologically comfortable that the full stop R is very far away, and he can trade that pretty much without pressure. I almost want him to have a little more pressure so that he can do a better job of the 2R battle drill. But if he can trade without pressure and have a coin flip that pays almost 2 to 1 with no overnight risk and has 3 trades a day and can net 4% a month, and he's not optimized, I think that's pretty good. So the all-time greatest psychological lesson that you can learn, that your position sizing risk should be at a level where you can let the system simply perform, where you can trade with a relaxed hand on the reins. Continuing, the best moves occur in the first half of the day. The later trades are a little chaotic. So this is all about knowing your system and the setups. That he also notices down here, good setups don't linger around, they move to profit right away. So when you get this max pain range compression and it takes off, if this move to the downside was irrational fear, then people are going to see this as an opportunity to say, hey, fear is over and the fair value is up here somewhere, or maybe it's up in here, that this was an exaggeration. It's going to quickly move back to fair value. You know, even like a two-thirds retracement, and you want to capture that sweet spot in the middle. So if the best moves occur in the first half of the move, then you got to get in, you got to hold your nose and buy it. Max pain really helps in keeping the intraday losses low. Low stress. Exits are pretty quick in both profit and loss. You find out right away if you're winning or losing. There's not a lot of lingering around. That minimizes the stress. Not carrying any losing positions to the next day. Easier to sleep at night. Minimizes stress. See where we're going with this? Good setups don't linger around. So what that should tell you is when you have that setup, that max pain, range compression, and you think it's going to head back up to here, if it opens inside here and doesn't resolve, the longer it takes to get out of that little channel, the less and less it looks like this was an anomaly that's going to spring back. So you have a certain time factor built in to say the best ones happen sooner. They realize that this was oversold, and they want to run it back up to fair value in a hurry. Now, it may not be the place where the pain started, but if fear is 3 times more powerful than greed, it wouldn't surprise me that 2/3 of the move was associated with fear. And so when it stabilizes and rebounds, the immediate move is the better one. On average, 3 trades per day. He found that to be very manageable with lots of opportunities during the day and during the week. And he says maybe he's grinding too far because the system quality number was low. And I said, look, you haven't even optimized the 2R battle drill yet, and you're making 4% per month on 3 trades a day with plenty of opportunities and no overnight risk. he's on a scholarship and getting paid to learn. That's how I interpret that. So the SQN is is not improving. He's going to find that the SQN will get better, as is 2R battle drill. Excuse me. His SQN will improve as the 2R battle drill improves. The win rate could be better. Hey, it's good enough already. It's a coin flip. And with it not optimized. See, I think he's going to have some... He has some trades where it doesn't start moving immediately, and he's holding on to it too long, and he may be able to turn some of those losers into scratch trades. And that's going to help his win rate a little bit, but it's still good enough right now. He's learning more things about intraday practice, and he's going to get better with practice if he studies the performance and then works on the 2R battle drill. He likes the idea of the VWAP. He's looking for more information, so he should look up the market profile. Let me see if I can get back to Peter's. Maybe I missed a question from Peter. Okay, here was how to fine-tune RLXD entries and exits in the OWL chain trading. In a choppy market, there could be many RLXDs as shown in some charts. Okay, so here, what I want you to just notice is this idea here. Hold on, let's see if I can get yellow. SQC breakout. Let's get some of those. I want you to notice the RL10s, the higher lows. All right, so I don't mind. I think that's a nice owl right there. You're looking for a return down to the RL270. I like this. I like this scratch, stop, and reverse. I think this one you should not have let that one become a negative or a scratch. Now on this one, I want you to notice that right here, the MACD histogram has gone below the 0 line, so you should have a short bias on this one. And so I really like this. That's a good win. This one had a lower high. That's a good one. That's a good scratch. Now by this time, I want you to notice all of these in here. This is Crocodile River. There's nothing happening inside here. We're at fair value. It's already late in the afternoon. None of those are any good. By this time, with only a couple hours left, those moves are done. But the bottom line is, those are, I mean, it doesn't hurt to try them, other than you're paying some commissions. But if your commission rate is low and you recognize all of these are all possibilities, those are all scratches, those are trivial. Same thing here. This is where it went into the spring. Here's where it crosses into the summer. Here's where it crosses into the fall. That's the beauty move of the MACD right there. This one is probably an owl this way. Which should scratch, stop, and reverse. You have an opportunity to make that gain. That's consist. This is a really strong signal right here. When you have a nice move in the summer, the fall comes down and then it reverses above this 0 line. This is a really strong signal right here. All of the, when you see the see how narrow that river is getting and how tightly everything is compressed, this is very painful in here. However, this is where it crossed into the winter, so you're allowed to have a downward bias right in here. So you have a high, a lower high, a lower high, a lower high. At some point, these lower highs are telling you you need to get short in one of these little pockets, and you have an opportunity to capture some of this move. This is where it goes back into the spring. This is where it picks up the long side bias. So really, from this point on, it was 108.40. There was only a 40-cent channel inside here. But remember, the sweet trades occur in this first 90 minutes to 2 hours of the day. That's when you get that first move, and then often it's this long decay. So where we want to concentrate our effort is getting those first moves and that first owl out of there. All of these secondary moves less and less powerful. Exactly the same comment I'm making before. That's not a P1F anymore. This is not an unambiguous move anymore. This one I would agree with. That's a P1 outside of the river. Now these things are marginal or not outside the river. Those are not P1Fs. Those are not P1s. And again, I want you to notice, once you see this clustering around in here, that's Crocodile River. You're just going to get chopped up inside there. So the first big breakout move, yeah, your hybrid frog box entry was right here, about half of that, about half of this. So you should be on that move. And then if you try this one and then it scratches here, that's fine. And now you're in the fall. You might try this one where it breaks, where it's trying to break back up. It's below this river. It's below the river, and it crossed its own signal. So I don't mind this one or this one as an effort to try to get this. But once this thing rolls over and everything's back down around the 0 line, there's that run is probably done. And look how close you are now to the long-term fair value. This was the next opportunity over in here. When after a long period of sideways quiet channel, it breaks out to the upside and you have a long side bias. So maybe there's something in here. You have a low, a higher low, a second higher low. So maybe that's your breakout buy, and you're trying that one. Okay. Does that answer your question, Peter? Okay. That's everything I have to cover tonight, guys. I'm about 2/3 of the way through the research weekend videos for the presentations. They're excellent. There was enough interest. I sent out a little email poll earlier this week to see if there was interest in like a late November or early December live workshop in Kansas City. There seemed to be enough interest for both, so I'm working on the nailing down the dates. So I think it's going to be the weekend before Thanksgiving and then that first weekend in December, but more to follow. But we'll have a chance to do that. That's going to be not a research weekend, but like a boot camp on developing the trading plan, framing 50 trades of each type, day trades and then swing trades, so that we get the practice of 2-hour battle drills as well as trade framing and all that. I'm going to record those as well. So we'll do that in late November and early December. So more to follow. Okay, thanks guys. That's everything I had for tonight. You guys take good care, and we will see you in the chat room.